Hello and welcome everyone. Today we are going to discuss something very important, and I have with me Mr. Dhaval Gada. Dhaval is our uh, analyst for banking and financial services sector, and he's been in the industry for a very long time. He's been looking at this sector, I think, for the last 1.5 decades. Dhaval and I go back a very long time ago. We've worked together previously 15 years ago also. And something which Dhaval brings on the table is very sharp clarity of thought. And we'll try to put them together today, all the thoughts that we want to discuss. So today we will discuss banking and financial services industry today. I think it's one of the most important and promising area. And what we'll do is that we'll set the ground of what this sector is all about. We'll try and learn how these companies operate and how they make money, and then we look at some opportunities which we think are ripe at this point in time. So this will be the frame of reference for us to go for the next 30 minutes or so. So I'm Sahil Kapoor. I head the products team at DSP Mutual Fund, and we'll be discussing this sector in detail today. So Dhaval, just to kickstart uh, the discussion, I was thinking about banking as a sector itself, and it goes back a very long time. I think the first banking transaction, so to speak, would have happened maybe 2000 years ago or even more, right? We were discussing the other day that every other single sector which is there, or theme or sector, is cyclical in nature, whether it is technology, oil and gas, cement. They have been born and they have gone through their cycles. But lending money and transactions evolving money, they've always been there. Whether other businesses were there or not, but lending as a business has always been there as a structural story for a very long time. So Dhaval, I want to understand from you, when you look at BFSI, banking and financial services in Indian context, right? What does this sector bring to the table? And then we'll also take your thoughts on how do you look at this sector. But we want to first understand what is the context of BFSI in India? How do you look at it?
Yeah, thanks, Sahil. You made some important points that it is a very old sector. The form has changed, over a period of time, been far more formal, organized in the years that have gone by. And also, there are various facets to this sector. There is lending, there is saving, and investments. Then there is payments as a space. Transaction that you talked about involves payments. So that is one more layer. Then there is other financial services product related distribution, selling of those product and needs of customers. So it has various businesses, various facets involved. The way I think about this opportunity is right now, when India, give or take about 2 lakh crore, 200 lakh crore is our total credit, in India, compared to our GDP of more than 300 lakh crore. So, like we are more than 60% credit to GDP. And against this 200 lakh crore of credit across institutions, be it banks, non-banks, various institutions who can lend in a formal way, they generate about 3,50,000 crores of profit. That's what they did in my estimate last year. So that's the size of opportunity. It's very large, and it's growing at double digit, mid to high double digit. So it's a very large opportunity. So that is one aspect. Along with that, the other opportunity that comes around with this, sector, which I talked about, was related to, investment and savings need, which can be classified into insurance or asset management, wealth management. That opportunity is north of 70,000 crores of profit pool between insurance company, asset management, wealth management. So that is another large pool that is out there, and again growing in double digit mid to high double digit. So that's one more layer. And the last part, which is a more a recent phenomena, I would say, which is the payments businesses. So historically, payments was done either in cash or in banking, networks. So that is how historically payment mechanism was, be it check, debit cards, cash. But with this, digital stack that we've all, sort of learned and understood over the last many years, there are now dedicated payment companies, and these pools are becoming large and large. Just to give context, a credit card, for example, is a very large, more than $1 billion, profit pool, and growing in the 20s. So that those are the opportunities. UPI, dedicated companies. So those are other newer set of opportunities. They are small today, but are growing at a very large pace. And so that is the other layer of opportunities. To sum up, we are in midst of large uh, profit pools, large revenue pools, growing. Like you rightly said, this is cyclical in very short term, but it's structural in a very long term sense. So that is how I would put at this businesses.
Sure. Dhaval, I would want to explore all the parts that you mentioned: lending, wealth management, some brokerage companies, AMCs, insurance companies, NBFCs, etc. But one question is that over the last 30 years, Indian GDP nominally has grown at about 13.5%, right? And that's the kind of growth rate even, let's say, Nifty earnings would have shown, some best median sectors would have also shown. How fast is this sector growing or has grown in the past? Is there an alpha available in this sector that we've seen? And what is the source of that alpha? Why does this sector, if it grows at a faster rate, why does it grow at a faster rate?
Sure. So, on average, if you look at lending space, that is a 16% CAGR, growth story, both top line and on profits. Insurance business, I mean, historically, general insurance has been 16% CAGR, and life insurance has been slightly higher than nominal GDP as the insurance penetration has expanded. Both have different, profit structures which are not necessarily linked to economy, but in long term, they have reflected the top line CAGR of these businesses. And asset management again has been a 15% plus CAGR story. So all these businesses have done better than nominal GDP in long period of time. The source of alpha, in my view, is financialization of each of these subsegments. So that is one big driver of this extra, excess that we see on top of GDP. To give some context around this and explore this part of financialization, uh, today we have more than 200 million live customers, live borrowers in the bureau. This number 5 years back would have been less than 100 million. So, like, the delta is, like, in 5 years we would have doubled or more than doubled the number of customers, borrowers in lending system. Similarly, we've all seen the journey as far as a demat account opening is concerned, which is a reflection of wealth management and growth of asset management and wealth management, which is again, phenomenal. I mean, north of 15% CAGR. The other bit is on insurance. Over the last, like 10 years, if I were to say, we've let me split the conversation into two, life and non-life. In non-life, in the last 10 years, we've seen deregulation, de-tariff, take place, which has expanded the, opportunity. Number of players have gone up. We have now more than 60 non-life companies, which is probably doubled in this period. Um, So the number of players have gone up. The number of opportunities in terms of insurance, thanks to government support on the crop insurance scheme, on the motor, vehicle scheme, asking customers to have third-party insurance as mandatory. So all that has led to 16% CAGR growth.
Sure.
So that is one. And still, despite this, the penetration levels compared to global average, we would be significantly lower. So that is as far as non-life is concerned. On life, uh, I think in the last 10 years, the penetrations have broadly remained stable. They have not expanded, but the quality of business that was written has changed materially. So, protection, for example, as a theme. So, life insurance company, one of the reasons they exist is to provide risk cover to customers and to their beneficiaries. And so that business 10 years back was very negligible. Less than 2% of the business used to come from that part of the pool, which we call as retail protection or group protection. Today, that is more than 5% of the business at an industry level. Comes in our view comes from this segment, and so the quality of business has changed dramatically. The mis-selling, which used to be a problem of life insurance companies and the industry in the past, that has come down dramatically, and the surrender rates have come down dramatically. So I would say the penetration level or the growth rates of life has been broadly in line with nominal GDP over the last 10 years. If you look at 10, 20, 25-year view, yes, it has grown faster, uh, but the quality has definitely improved. So I think broadly, to summarize, I think that the extra alpha that you generate on top of nominal GDP as in BFSI, I think that attribute goes to financialization and deepening in each of these businesses.
Sure. So I picked up 3 points, Dhaval. One is financialization, as you said. Second is opening up of the sector. You said that earlier, a lot of it was restricted by a lot of regulations. Slowly, it opened up and more
Yes.
opportunities started to come. And third is the quality of the business, as you said, that has kept on improving over a period of time. And you cited some very good numbers. 10 crore borrowers have become 20 crores in last 5 years, as you said,
More than one.
doubled up in numbers. Demat accounts we've all read in newspapers have gone up to 14 crores, 8 crore unique Demat account holders, right? Unique folio numbers in mutual funds are reaching about 3.5 crores or so. So these numbers are very encouraging. They tell us that there is a structural uptrend tick which is happening in across the sector. But I would want to understand two very specific things. A, how do these businesses make money? Maybe we'll take one example, let's say banking, right? Very crude terms, we'll explain how a bank makes money. And second, how do we judge whether the bank is profitable enough or not? What do we look at? What return ratios do we look at to judge and see, how profitable the bank is for an investor? And third, how do you value it? What are the 2 or 3 parameters do you look at? So we'll try and put up a framework to look at the larger scheme of things across this, and then possibly maybe at the end we'll try to break up, a 100 rupee portfolio. How does it look like when you invest in a BFSI segment as a whole, right? So let's start with looking at how does, let's say, picking up an example of a bank or an NBFC or any other business that you want to cite. How do they make money? If I am a depositor and I come to a bank and put 100 rupees, how does it work?
Sure. Yeah. So I'll simplify the conversation to a very, very basic level so that
Yes.
everyone understands this. So let's take an example of bank, and then we can easily move to NBFC or a non-bank. In case of a bank, the basic business is taking money from depositors and preserving it and lending to borrowers who need it, and in the process serve the customer. That is a basic business of a bank. Now, in this conversation, you observe that the bank collects money in form of deposits from the depositors. So there is a cost that it pays or interest that it pays to the depositor. So that is one. So the expense for the bank is cost of deposit. Let's simple example. Let's say it is about 6% is the cost weighted average cost of
All
saving account. current account, term deposit that a customer keeps with a bank, 6%.
Right.
Now, against that, there are some customers existing to bank or people who are not banking, but they've come to borrow money to this bank. Now, this money that the bank preserves, almost 75% of that goes back into lending to some of these borrowers. 25% it keeps in form of investments, liquidity, which is basically when the depositor comes back to them to withdraw their money, this liquidity is utilized to honor their obligation. So 75% of the money is lent out in form of either home loan, auto loan, consumer loan, or to a corporate for a project or working capital. So any borrower requirement. Let's say for a simple conversation, this weighted average lending done is about 9%. That is the rate that they earn on this 75%.
That
The
is
balance,
the cost of funds
there is
for the
a
borrower,
yield.
right? The interest rate the
That
bank
is a
is charging.
cost of that is a
Yeah.
cost for the borrower, and it's a yield on the advance that the bank gives. Uh,
Right.
so, so for simple term, 9% is what we assume that they earn on 75% of the money that they've taken. For the balance 25%, they park it some in very short term, some in medium term liquidity. Let's say for simple conversation, they earn about 5 to 6% on 5% on this investment portfolio. So they lose about 1%. So against the 6% that let's say Sahil has given to me, I earn 5% on my investment, so I lose 1%. But I have also gained on 75% of the book, I've gained 9%. So on weighted average terms, if you were to look at, you end up making somewhere around 7 odd percent kind of return against the 6% that you want to pay to the depositor. So you make a spread. The spread is called net interest income. Basically, in banking terms, it is called net interest income, which is nothing but the difference between what you have earned from your investments and advances and what you paid out to your depositors or borrowers. So that is the difference, which is called net interest income. You earn the spread out of it. Then the other thing which I talked about is the service that you provide to your customer in this process. So there is a fee that the bank earns by offering a debit card, by offering payment services to the customers, by offering loan services, by offering insurance services, mutual fund, third party products. So all this you earn a fee, which typically in a bank is about roughly 1% of the total assets of the bank on average. Very simple terms. So you earn about let's say 1 odd percent on 1 to 1.5%.
Interest.
In our example, we earned about 1.5%. In real life, the bank could earn about 3 to 4%. 1.5% in our example, 1% fee. So that is the income for a bank. Now on the expense, it is predominantly 50% or more than 50% of a bank's on average again is employee cost, which is the branch people, the people in the collections, loan disbursement, head office, etc. So roughly half or little over half of a bank's cost is people. The balance is between technology, infrastructure, branch infrastructure, rentals, and other advertisement and other loan sourcing cost, etc. So that's roughly. Typically, as a thumb rule, a very efficient bank would be at about 35%. Very, very efficient bank would be at about 35% cost to income. That is the kind of
Right.
typically a very efficient bank, which means 65% is the margin that they earn in
So
an efficient
basically, in
bank.
our example, they were making around 2.5%, 1.5 in NIMS and 1% in uh, the
Fee,
fee
other
income.
income.
So 2.5. So one third of that will be shaved off as cost, right?
Correct. Yes.
So roughly
And the
about
balance,
175 will be the
yeah,
income.
yes.
Okay.
And so that is an efficient bank. Not so efficient or average would be somewhere around 40 to 45% cost to income. So very efficient, about 35%. extremely poor more than 50%, and average would be somewhere around 40-45% is where the bank would operate. Then the other bit which is there for a bank is the credit losses
Right.
that it incurs on the loans and investments that it has made. So on the assets, there would be some non-performing loans which are charged off. Again, a very good bank would end up, having a credit loss of between 40 to 50 or 60 basis point. A very and it again depends on the business model. If you have higher risk loans, so instead of 9%, if you end up doing business in segments which are in high double digit, mid to high double digit, your credit losses are likely to be higher because you're pricing some of the risk or operating cost of doing that business. So it depends, varies, bank to bank, model to model. But roughly the range, if I were to give you a range, between 40 basis points to anywhere between 200 basis points would be the broad range of credit loss on average, through cycle for some of these banks. And so therefore you make return, pre-tax return on asset. You pay tax. Most of them are full tax companies, and that's how you make ROA. This is how the business model works. So to summarize very simplistically, you earn a spread out of the lending and borrow deposit taking activity that you do. You earn fee income and other income out of the services that you provide to your customer. Your key cost, two big key costs are employee cost and infrastructure cost and tech cost, and the other is the charge off that you make, or the losses that you make on the assets. So these are
What we
the,
call NPS roughly
which
in
is
our
called
day-to-day
NPS.
life. Right.
Yes.
Right.
So
Right.
that is how the model works. Typically, to answer your second part of the question, and it will help you, bring context to everything. So, if you look at Indian banking system, in good times, we end up making somewhere around 14 to 15% ROE at a system level, return on equity. Um, and that is a key measure that I believe, along with the portfolio quality, because you can defer your provisions by 1 to 3 years. So, along with return on equity, the other key metric to look at is the level of stress,
Right.
to see how much is the unprovided portion and whether the ROE is sustainable or it is temporary. So, but through cycle, the one, if I have to pick one metric through cycle, it would be return on equity. And we've done exercise globally across banking system to validate this hypothesis that in long term, the multiple of a bank, in this case, price to book, for example, the re-rating or de-rating has very high link to the return on equity profile differential at the start and end point. And hence, I think return on equity is very important through cycle, and sustainable return on equity is very important. So that is one metric. In good times, banks make 14-15%, which is what we've made in FY23 and likely to make in FY24. This is a similar level we made in 2007. So that is how the model is. And in tough times, this number could be low single digit, and in extreme scenarios, it could be negative, which we saw somewhere in FY18 when the
Right.
system as a whole reported a negative number. But so that is how the range is on the system level, and so therefore the key numbers to focus is return on equity, NPA levels, the stress levels. Those are the key numbers. Apart from that, return on asset is also an important metric. It is equivalent to a profit margin in other businesses, net profit margin in other businesses. So that is also an important metric to look at. And the last bit is capital levels. So everything that we do in this business has extreme levels of financial leverage, and therefore focusing on the level of capital against the lending or against the assets that you've created is extremely important. And so that is the other important metric. Commonly, people focus on core equity capital levels. Valuation metric quickly is price to book is a general number that most investors and market focuses on, because the earning profile can be cyclical in short periods of time, and therefore price to book represents a better way of valuing these businesses. So in some of the structural stories which are very unique to India and some of the other South Asian markets, we do focus on price to earning multiple, because the earning profiles are far more structural, and therefore price to earning is the other metric that investors focus on. Yeah.
Sure. Thanks, Dhaval, for that. Well, I think this was clearly banking in a nutshell, to be precise. But as you know, that BFSI is a mix of so many things, and I think our conversations has also thrown some interesting points that it is now becoming sort of an uncorrelated subsector theme. There are too many different ideas which we can look at within this BFSI space. So let's say if we have 100 rupees of the overall market share, what is the proportion of banks versus non-banks versus the other themes? For example, a fintech or a payments business or an insurance business. What is this breakup? And when an investor looks at this sector, what should he be focusing on? Because banking, very, very large gorilla in the room, but it is growing at a certain rate. Are there other opportunities also which are uh, maybe more profitable and also growing at a good pace?
Yes. So a very important point, and there are two points that I would like to make. So pre 2017, if you were to take any banking or BFSI index, more than 90% would have been lenders. That composition is gradually shifting away, with number of insurance companies getting listed, number of asset management companies getting listed, payment companies getting listed, wealth management, exchanges. So all that coming into picture, definitely lending as a pool, while it is large, the share will is coming down rather. So that is one important aspect. Why this is important is lending has a very different risk profile compared to the other segments. So like we discussed in insurance, it is linked to mortality risk, it is linked to pandemic risk, linked to investment related risk. In case of let's say wealth management, it would be linked to how stock markets perform. In case of exchanges, it would be linked to the level of volume that happens on the exchange. So very different set of characteristics of each of the business, uncorrelated to a good extent between them. So which helps in better portfolio construction. The other aspect is that you touched upon is on the allocation part, and whether you should own other businesses or not. Now, like we discussed in the start of the conversation, that lending as a pool is very large in terms of profit, in terms of size, it is very large. However, some of these other opportunities are also becoming larger, and they're growing faster than lending. And they are different, diversifying risk profile compared to lending. Hence, I believe that as economy expands, more formalization takes place. Some of these companies are listed and available for public investors. You should evaluate these relatively high growing opportunities, different risk profile compared to traditional lending risk profile, and therefore you should have asset allocation. From my perspective, if you were to ask this question in 2017, I would have said 90% of my portfolio would have been lenders. Today, that number would be less than 80%, and it would be even lower as we move along in the next few years, as more and more options are available, especially in fintech space, in insurance space, wealth management space. As these opportunities open up, more players are available, larger players are available. You will see portfolio construction shifting away from lenders to these opportunities, which are growing faster than lending opportunity. So that's first part. Within lenders as well, one important thing to note is there is profit consolidation which is taking place both between lenders and even in insurance, but specifically on lenders there is profit consolidation that is taking place. And therefore again, designing your portfolio to focus on companies which are going to gain profit market share along with revenue market share, those are the nuances that you need to figure out and allocate. So maybe few years back, our allocation towards private lenders, both in the NBFC and in the bank space, would have been very high, given that the public sector entities were losing profit and revenue market share. However, in the last year and a half, they have stabilized their revenue, market share. Like loan market shares have been stable. The incremental shift is not as sharp as what it was a few years back, and they are gaining on the profit market share. So some of these companies which were in negative territory have been moving to positive territory and normalizing their earnings, which means they are gaining profit market share. And therefore, the portfolio construct has also shifted accordingly. So keeping that bottoms up approach is equally important even within lending space.
Sure. Dhaval, I'll come back to the question of quality and to one or two segments in lenders and banks. But I want to ask you a different question. Globally, we've seen that India has taken a big lead in terms of technological infra when it comes to banking, BFSI. We've got UPI. No other country has been able to build such a superb payment platform, and it's transforming how we, transact and do financial transactions in India. Do you think this has an edge for this sector as a whole? Because we've seen globally, banking is a very, very varied sector. In some countries, it has done very, very well, BFSI. In some developed countries, they are very large companies, very profitable companies, while in some other geographies, they are completely dead. There are too many skeletons in the closet, right? So in case of India, do you think that we have progressed differently versus how many other countries have progressed in terms of financial infrastructure? And does that hold an edge for this sector as a whole?
Yes. So very important point. And I believe that the digital stack that India is created and is creating is a very big differentiator in terms of the way the businesses and business models will be created or are getting created in India compared to some of the European markets where, like you rightly said, banking sector has not generated enough wealth, or the sector has been a very low ROE.
They become like utilities only, I think, in
utilities kind of model. Yes, correct. So the way, and it's a very big topic, but I'll just try to very simplify the conversation. So the way our tech stack has developed, the digital infrastructure, public infrastructure has developed, be it UPI, which enables flow of customer transaction for a lender, to, let's say, the Aadhaar system where KYC becomes, or knowing the person who is taking a product, simple, to, let's say, an account aggregator framework where the entire transaction, not just banking, but the entire asset transaction of the customer, be it asset management portfolio or stock portfolio, every part of an individual's asset part gets digitally transmitted to the lender to be able to underwrite the customer. All this flow of information helps the lender make a better decision on the customer, price the customer in a right way, and more importantly, gives the borrower option of multiple lenders being able to offer him credit. Today, more than 35 lenders offer personal loan compared to less than 15, 5-7 years back. So the flow of information helps both the borrower as well as the lender. What this does is it reduces the tail risk of a systemic collapse in case of a downturn or a very severe asset quality cycle. And we've done the same sort of with similar principles. We are building the corporate part of database as well, where each corporate group level information is getting transmitted by a reserve bank to the lender to make a more informed credit decision. So basically, it helps remove the tail risk from the system. It also makes the system more efficient because most of these activities are done digitally. So cost of doing or lending comes down. It makes the system more efficient and therefore lower rates to the borrower and a better operating efficiency for the lender. So both these aspects are very important and they are sustainable from a long-term perspective, which makes the model more, sort of secular from a long-term standpoint. There will still be short-term cycles because competitive pressures will make lenders go overboard at very good points and be very cautious at tough points. But at least from a long-term standpoint, it makes the sector on a rising trajectory and deliver that GDP plus outcome. So that is an important aspect. And this also all this relates in terms of like the data points that I discussed earlier relates to number of borrowers increasing, more transactions being offered at a credit being offered at a transaction level rather than at a individual loan level. So earlier, you or I, we would have gone for a home loan or a auto loan or a consumer loan. Today we get loan at individual transaction when we make a payment, be it consumer durable at a electronic store or a purchase on online platforms. Each transaction can be converted into credit. So all this makes need based solution as well as more risk based profiling for the lender. So yeah, so that's how I see it. It will make the business model far more resilient in downturn. That's how I see, and expansion of the market. Yeah,
I see this like FMCG companies going from 500 ml bottle to a small sachet. So it's becoming like
correct,
bite-sized banking, which is true. But
correct,
in a lot of your comments, I hear the term quality, risk, credit appraisal, right? These are very, very important themes. So my next question is, how important is quality in this business? It's often said that it's the banker, not the bank, right? So when you look at banks as a whole, last 10-15 years, there has been many accidents. We've seen that not just banks, I think across the financial
correct.
services industry also, we've seen a number of accidents happen, number of failures happen over a period of time. So I want to understand what is your investment framework theory to when you look at this segment as a whole, what are the landmines that you will sidestep in terms of your investment philosophy? And within that framework, I want you to touch upon how do you think about this topic of PSU banks versus private banks, etc. Is it a top-down call that you take, or is it entirely driven by the quality of the business call from a bottoms-up perspective? So your investment philosophy around these two contexts.
Sure. So, in the answer, I think both of these will get covered, which is
Sure.
basically my investment framework. First thing, it is split into two parts. The first part focuses on the stock selection. So, when I look at a business or a company, the key focus is what is the uniqueness, whether there is any distribution advantage, there is a cost advantage, there is a leadership in any of the vertical which the company is leveraging to build ancillary businesses. So there has to be some uniqueness to the model. It could be cost leadership on deposits, for example. So that is how first identifying what is the profit pool or uniqueness of the model. The second bit which I look for is in the medium term, not necessarily 1 year, but in 2 to 3 years time frame, the company has to maintain or improve its market share. So it has to do better than the underlying industry. So that is the second thing that I look for. That it has to be growth oriented, has to do equal or better than the industry. The third thing that I focus on is the return profile. Again, not necessarily 1 year, but a sustainable return on equity greater than the cost of equity is the bare minimum that I look for in a business. In the past, businesses which have delivered low return on equity, even in good times, so which means that they have very low profit pools in good times. So in bad times, they're likely to disappoint on outcomes, require capital, etc. So typically, I've avoided businesses which, on a sustainable basis, do not generate return on equity more than cost of equity. And the last bit is the entry point that I make in a particular stock does not have to be more than one standard deviation above long period average. It can
Right.
be above long term average, but it cannot be more than one standard deviation above long term average at an entry level. So those are the key points that I look for when I select the business. In terms of sizing of the business, uh, and that sort of answers some part of the second point that you raised, which is the key things that I focus when I look at sizing of these opportunities in the portfolio. One is where we are in the rate cycle. The businesses uh, sometimes by design do have links to the interest rate cycle. If you are a lender who is running a, a shorter, borrowing book and a long duration asset book, you are likely to be vulnerable to a sharp rise in rates, because you will come back for deposits or borrowing faster than you come back for your assets to be repriced at higher levels. So interest rate cycle is an important consideration. Asset quality cycle is a very important consideration. And typically, I've observed that good lenders in down times, in extremely benign credit environments, will have significantly benign GNPAs and NNPAs compared to on the other side, the companies who still have above industry average NPA levels even in good times. So when, let's say for example, if industry GNPA in home loan is about 2%, and if a lender is about 2.2% at this point of time, and then there is one more lender who is at 0.5%, the likelihood when in a bad time when this NPA were to double and go back at an industry level to 4%, the lender who is at 2.2% is likely to be more than 5, 6, 7%, versus a lender who will still be significantly below industry average in a downturn or in a worst point of the cycle. So focusing on the asset quality traits of a business in good times, through cycle, and where we are in the cycle is very important. That's the second consideration for sizing: interest rate, then asset quality. The third bit is the return ratios in the very near term and the growth profile in the very near term. If a business is, there are instances where businesses do make excessive investments, and in the near term earnings are suppressed by them. In those scenarios, I've observed that generating alpha becomes very difficult, because market may or may not remunerate the medium term outlook of the business. So, which is why you may still like the business and you may have in the portfolio, but you may size according to the near term growth and return consideration. And the last and the most important two bits are relating to management quality. It is a significant alpha generator in good times. It is a significant alpha generator in tough times as well, because managements who have demonstrated that they deliver in line or better than their guidance have generated excess returns compared to the benchmark, is what I've observed. So management quality is important, and ownership pattern. Some of my mistakes in the past of not generating enough alpha or being detractors in the portfolio have been stocks which are very overowned by either domestic or foreign investors, or they are overowned by a lot of old private equity investors. What these stocks have done, perform, even though their business performance has been, reasonable or in line with my expectation, but stock price performance or return performance has not been up to my expectation, because they've constantly been, sort of burdened by the supply pressures of some of these investors. So ownership is a important consideration, which is something that I've added in the last 2 years when I've observed my detractors. So those are the parameters that I look for. To summarize very quickly, uniqueness of a business, return ratios, uh, extra return growth over the industry and entry point of valuation. That is for stock selection. And for weight management, it is interest rate cycle, asset quality cycle, near term growth and return profile, and quality of management and ownership pattern. So these are the key pillars. And the last bit is to your question of PSU versus private, growth versus quality or value. So to me, it is a very bottoms-up approach. Like we discussed in earlier part of our conversation, when the data changes in a particular segment, and if the valuations are reasonable, if the growth rates are reasonable in line with industry, they should be considered from a selection perspective. And then weights can be managed based on the quality of management, quality of ownership. By the rate cycle, by the asset quality cycle, all that can be done by weight management. But at least from a selection perspective, they should be part of the portfolio. So to answer your question, it's very bottoms up. And one example that I can think of last year. So for a very long period of time, I was reluctant to buy the power finance companies which are out there. And the key reason was my view was they were sort of deficit financing business models that were getting created. They've not demonstrated, unique their ability to underwrite private sector risk in the past. However, one big change was made in that assumption when, sometime last year, the way some of these business characteristics in terms of the underlying borrower, for example, discoms, the way they were restructured, the way they moved, the characteristics changed. And that data point change plus the valuation, entry point of valuation, we added that in our portfolio, and it has been a big wealth creator in the
Sure.
portfolio. So being bottom up is very important in my view.
Sure. So no broad brushing. Basically, it's a purely bottoms up call, looking at the business. Dhaval, two last questions for you. One is that we've seen very strong, good, profitable businesses exist everywhere in the world. So are your opportunity set open to opportunities outside of India? Do you think there are businesses good enough to capture?
Yes. So it is an area that I've been investing time and effort over the last few years. Uh, Understanding some of these, as I've learned India, I've understood some of the uniqueness of the global businesses, and I've been investing time and effort to sharpen my knowledge and understanding of these businesses, the price performance, wealth creation with these businesses. And I do believe that there are opportunities outside India. It may not necessarily be a lender, but it could be
Right.
a strong platform, some unique business model which is global, and that opportunity is not available in India. There are businesses like that, and yes. So there, to answer your question, yes, there are opportunities outside. It is an area that I've been investing, and as confidence comes, as some of the opportunities one can invest, it is something that we will look for.
Sure. Maybe we'll have a conversation around that sometime in the future. Last
Sure.
question to you, Dhaval. Where are we in the cycle? When you look at the sector, do you think this is the right time to look at BFSI as a sector?
Yes. So we discussed enough to demonstrate that the sector generates wealth over long term. So there's no question on that. In terms of near term, since the pandemic, start of the pandemic, the sector has underperformed. Nifty, for example. My view is we are at long-term average in terms of valuation as far as lenders are concerned. As far as insurance is concerned, we are up below long-term average. The history is limited, but we are below long-term average. And therefore, from an entry point, we are very well placed. From a growth perspective, I think we are at the start of a corporate credit growth cycle, which is
Right.
something in the past, in previous videos, I've highlighted that one of the reason credit growth has been in single digit or lower, for example, is because corporate credit contribution has not been material since
Right.
2013. And that has come back. Last year, it added 4 to 5 percentage points to overall system credit. This year, it is likely to do similar or better. So as that comes back in form of capex, in form of working capital requirements of corporate, it is likely to accelerate growth, earnings growth as well for the sector. As far as asset quality is concerned, we are at a very benign point on credit cycle. Part of the reason is that most lenders have been conservative in 2020, 2021, 2022. So in those 2 to 3 year period, lending has been extremely conservative, and hence in the outer years, which is 2023, probably 2024, you're likely to witness benign, credit quality compared to long term average, and therefore overall cycle is benign. Similarly, on insurance, we are coming out of pandemic. So both on the health side, insurance, general insurance companies faced huge claims. As far as life is concerned, we faced huge claims on mortality sometime in FY22 and 21. So all that is behind, and companies have started accelerating growth and seeing better performance as far as underwriting is concerned, which should reflect in better return on embedded value for life insurance company and better ROE for non-life companies. I think overall outlook for those businesses from a medium-term perspective remains quite good. As far as wealth management is concerned, I think as financialization keeps on improving and expanding more and more, we'll see assets grow, and therefore given that some of these businesses are capital light, so earnings and cash flows will keep on expanding at double-digit growth pace, and that should be quite reasonable for investors. So I think across the board, I think from a long-term investor's perspective, this is a very good point. In the near term, we may be impacted by ownership, by global headwinds that some of the economists and strategists have been expecting. But from a long-term investor's perspective, especially in BFSI space, I think this is a extremely good entry point.
Sure. So, Dhaval, this is a profitable, growing structural sector which has withstood the test of time for a very, very long time. And as you said, this is a good time. We never know which is the best time, but it is a good time, as good as it can be, to be in this sector and take benefit from the upcoming trends. So thank you, Dhaval, for your time, and thank you everyone for joining in. And we'll break here, and we'll get back with Dhaval with more insights on all the sectors that we discussed within the BFSI space. Thank you, everybody. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.